for assuming risk. In fact, the riskier you were willing to be, the more you have benefited. Just to look at the fixed income market for a second. Over the last 12 months, Treasury bills, as you know, have paid essentially zero. Long U.S. Treasury bonds have actually had a negative number. Intermediate Treasury bonds have had, say 7 to 10s, have had about a 2% return. So if you wanted to stay with things that had a predictable asset value, you haven't been paid well. Compare that to junk bonds. Junk bonds in the last 12 months have been up 61%. And the worst of the junk bonds, the triple Cs, those things that are barely breathing, have been up 130% in the last 12 months. So it has rewarded great risk-taking. We had a poor 12 months. Through the end of February, our portfolios in the last 12, where we had asset allocation responsibility, our portfolios have been up about 5%, and very little in the last 6 months. Most of that was in the first 6 months of the 12-month period, because we were not willing to accept that risk. And our specific stock approach, we look for two things primarily. We look for a number of things, but two primary things. Stocks that we can buy at historically low valuations relative to their history and their relationship to the market. And then the second thing is they have to have growing earnings. And they have to be growing year over year every quarter. Now that's very conservative. But over 25 years of doing that, the performance number has been dramatically better than the S&P 500 for the stocks we've bought. We have bought almost no stocks in the last year, and none recently. Initially because 12 months ago, there were almost no stocks with growing earnings. So that part of our screen kind of ruled everything out. By the time earnings started to rise, the confidence, well, not at that graph, but the confidence level had started to push stocks up enough that we were no longer meeting that second major screen, and that is we were not finding stocks at historically low valuations. So we weren't willing to take the risk of stepping up to a higher level type of risk. That hurt us this year. But even with that year included, which is very poor relative to what was available in the markets, our 2-year numbers are good. Our 3-year numbers are very good. Our 10-year numbers are really, really good. We've had poor years before. We do intermittently. When we're out of phase, when one of those two factors is just not, we can't get much. Either the earnings aren't there or we can't buy things cheap. We're going to be out of phase. We've been doing this for 25 years. Maybe we've never yet had a time where we've been out and the market hasn't brought it back to us. There can always be a first time. Maybe this market will keep going up and will never come back, and we will have said, we missed a real opportunity. Maybe. But I have not found a better process for us to use, because the process has produced very good long-term numbers. Let me just finish up here. We've gone more than I expected. With great uncertainty, we still see the potential for either higher or lower prices for both stocks and bonds. On the bond side, keep in mind, rates right now, where they are today, they were up strongly today, but rates are below historical norms. Bonds will be a good investment only if rates go either lower or at the very least stay where they are. And that is likely to occur only if the economy remains sluggish. So if the economy remains sluggish, bonds could be a good investment. If it remains really sluggish, goes back into a recession, government bonds might do fine, but corporate and municipal bonds might get hammered. And we still have not gotten rid of the default potential on the corporate and the municipal side. That's a very real possible event out there. Now, of course, we're even talking about defaults of countries as a possibility. Dubai got rescued by Abu Dhabi. Greece is probably going to be rescued either by the EU or by the IMF, one or the other. But what about Spain? Today, Portugal's debt rating was lowered by Fitch to AA- with a negative outlook. More and more debts are coming due. It's going to get tougher and tougher to pay them off. Debt ratios have been in the news just in the last couple of days about the United States, Japan, and the United Kingdom. Dangerous debt ratios. International Monetary Fund made a statement this week saying that the debt ratio problems are going to put a real crimp in the style of future growth in these major economies. And they're saying that the major economies have built themselves with this debt edifice into a very dangerous position. On the stock side, earnings are rising, but they're not back to prior levels. It's largely from cost cutting, and we've only seen the very beginnings of revenue increases for the vast array of most companies. World business is clearly improving, but the open question remains, can it continue to improve and be sustainable without a substantial amount of continuing government stimulus? We don't know. Debt levels are still at unprecedented levels through most of the major countries of the world, and the major economies are still sluggish and burdened with housing problems, unemployment problems, and debt problems. Clearly, the emerging economies are the stronger ones, but they've never yet been leaders of a world recovery. So if it's going to happen, this will be a first time. I would ask each of you in evaluating, and here I'm talking about the stock side, when you look back over the vast array of financial and economic data over the last 100 years or so, ask yourself, is this condition we're in right now better or worse than average? Think of it in terms of personal safety, employment and income potential, stability of our currency, or overall economic prospects. Is this better or worse than long-term average? The majority of owners of stock are betting that it's better because they are paying way above historically normal average prices. So they're betting that it's better. They have to be right. If they're not right, there's a lot of room under those current prices, even if fundamentals stay just the way they are, don't change up or down. On the other hand, if housing or unemployment or the debt problems prevent the consumer from coming back as strong as he has historically been, and if the government can't withdraw the stimulus without unintended consequences, there is still a great danger to possibly lower stock prices. The potential is there for gain, but the risks are large, and the potential for further losses is also there. So I leave you at that point. We're going to be around. We welcome you to have a drink, have some food, ask some questions. We'll be around privately. So we'll look to talk to you later.